Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Thursday. Let's take a look at the macro picture. And US economic data showed the services sector unexpectedly accelerated in August as inflationary pressures remain amid a rise in new orders and businesses paying higher prices. The Institute for Supply Management's non-manufacturing PMI rose to 54.5 last month, the highest reading since February, while a gauge of prices paid also increased from the prior month. The data raised concerns the US economy remains resilient enough for the Fed to keep rates at higher levels for a longer period of time. The yield on the 2-year Treasury note rose to 4.29%, while the 2-year yield jumped back above 5%. Meanwhile, the Fed's survey of the economy, the Beige Book, states that US economic growth was modest in recent weeks. Job growth was subdued and inflation slowed in most parts of the country. Boston Fed President Susan Collins has said that while there are signs of progress in cooling inflation, now is a time for the central bank to proceed carefully, saying the risk of inflation staying high for longer must now be weighed against the risk that an overly restrictive stance of monetary policy will lead to a greater slowdown in activity that is needed to restore price stability. Well, the US dollar has climbed to a 6-month high on the services sector data, while the euro and sterling hit 3-month lows. The Aussie dollar trading around 63.8 US cents. Well, China's trade balance for August is released today, with investors anticipating another slump in activity against a backdrop of rising US bond yields and new year highs for in the oil price. And we've seen a sell-off on Wall Street. Economists polled by Reuters expect a 9.2% year-on-year fall in exports and a 9% fall in imports. Chinese trade has been one of the biggest economic red flags this year. Exports and imports both plunging, reflecting weak overseas demand for Chinese goods and weak domestic demand at the same time. Well, let's get some analysis of the latest services sector data, both in the States and more broadly. I caught up with Roukaya Ibrahim from BCA Research.
Today we saw that the ISM services PMI surprised to the upwards. It shows that the service sector is expanding in August. So that definitely came as an upward surprise. Now, the S&P Global Services PMI, the alternative measure, that showed the service sector growth actually slowing. But if you take an average of the two, it's actually unchanged in August versus July. So it still suggests that the US economy is resilient, the services sector is resilient, especially when you compare it with places like the Euro area and China, where services sector has started to deteriorate. In the Eurozone, we saw on Tuesday that the PMI there, the services PMI there is now in contraction. So that's something that we're watching very closely as the deteriorating economic environment is spreading from manufacturing now to services.
How does that align, particularly what we're seeing in the States there? The Beige Book from the Fed just released stating that economic growth was modest in recent weeks, job growth subdued, inflation slowed in most parts of the economy. What did you make of that?
Yeah, so actually, if you take a look at the data that we got last week, so we got a slew of jobs data. We got the JOLTS, we got the PCE inflation data, so inflation data as well. We got the non-farm payrolls. And the signal from these releases was actually that we're more on the path of this soft landing scenario. So we're seeing, for example, the job openings rate and the quits rate from the JOLTS coming down. So that suggests that wage growth is going to slow going forward. It's going to continue to slow going forward. We saw the PCE core inflation rising by only 0.22% month on month, so quite a low figure. And we saw that job openings, they're still increasing, but they're, generally on a downtrend. And so, the signal there is that we're on this sort of benign disinflation track where the economy is holding up, but that inflationary pressures are receding. And what we saw last week is interesting because we saw, for example, equities, they rallied over the course of last week. But then when we got the ISM release today, we saw that equity sold off on this risk of a no landing scenario. And I think that this is what the market is really trying to understand. The no landing scenario versus the soft landing scenario, and it's going back and forth between these two. Now, my base case is that we're most likely going to see over the course of the next year inflation continuing to come down. The labor market is going to continue to deteriorate, and eventually that's going to lead to an uptick in the unemployment rate and eventually towards recessionary levels. Now, I'm still keeping a very close eye on what's happening with demand because there is still this risk of a no landing scenario where you see, resilient economic conditions leading to a second wave of inflation. But this is, I think, something that's more for the middle of next year. And so this is something that we're keeping an eye on, and because it would prompt the Fed to take to revert back to rate increases.
Yeah, in fact, the markets are weighing that up right now as to what the Fed's next move will be, of course. Interestingly, we did have Boston Fed President Susan Collins out with some further comments, talking about, I guess, that even balance there, saying that for now that they need to weigh up, will tread carefully at least in terms of rates staying higher for longer against being overly restrictive. So it's a difficult course, obviously, the Fed is treading at the moment.
Absolutely. And this is not just the case in the US, but it's also the case in places like the Eurozone, for example. We got some economic data from the Eurozone. Things like German factory orders came out this morning. That declined by double digits. We also got M3 growth contracted. We got that data last week. These things are showing that economic conditions are deteriorating in the Eurozone. And as I also highlighted, the services PMI is in contraction there. But we also still got the inflation data out of the Eurozone last week, which shows that inflation surprised to the upside. So I think that this is something that's, policymakers globally are dealing with, not just in the US, but also in the ECB. And they're trying to weigh, on the one hand, the risks from inflation that is decelerating, but is still too elevated to make them comfortable. And on the other hand, some signs that the economy is deteriorating. So I think that in general, policymakers are going to be more cautious going forward. In the case of the ECB, for example, if we do get a rate hike next week, I think that's going to be paired with some softer language about a reduced likelihood of any more rate increases after that.
So, Roukaya, just noticing, just in terms of Treasury yields, the 10-year in the US remains elevated, of course, the 2-year back above 5%. And the US dollar, now at the index there at 6-month highs. What are you seeing as the trajectory of the US dollar at the moment?
Yeah, that's a great question that really ties everything in quite well because what we've seen since mid-July is the DXY index has increased on the back of these signs of more resilient US economic conditions. The data that we've gotten so far, all of what we've spoken about, that really supports this trajectory of a stronger dollar over the near term. So I think that there is scope for the dollar to strengthen over the near term on the back of just more resilient economic conditions in the US versus in places like the Eurozone or China.
That's not good news, of course, for the struggling Australian dollar. And of course, that came under further pressure with our own Reserve Bank keeping rates on hold as expected. Nonetheless, though, of course, a lot of this is also tied to what is going on in China at the moment.
Absolutely. And, the message there is that policymakers are not yet willing to unleash significant stimulus. And this has been our argument all throughout this year that policymakers are going to be more reserved than they were in the past, that they're more willing to tolerate some deterioration in the Chinese economy. So I think that the message there is that, until they do unleash the bazooka, until they stimulate the economy much more aggressively, these China plays globally, including the Australian dollar, will face downwards pressure. But once they do, stimulate when economic conditions deteriorate to the extent that they're they're no longer able to tolerate, then I think that you'll see the Australian dollar strengthen versus, for example, the Swiss franc. And on that front, the Australian dollar has been the worst performing G10 currency so far this quarter, whereas the Swiss franc is the best performing one. So I think that this is a nice way to play out any positive news from China.
Similarly, well, the euro and the sterling also at 3-month lows, so the pressure there too.
Absolutely. And I think this also fits in with what's happening with the economic data. What we're seeing is the US dollar reigns supreme for now because of the resilience of the US economy. So, as I mentioned, economic data from the Eurozone, M3 growth contracting, German factory orders that we got today, these are all signaling that growth conditions are not that great in the Eurozone, and that's weighing on the euro. If you take a look at, for example, what's happening with the Euro area economic surprise index versus the US economic surprise index, the Euro area one is in negative territory while the US one is in positive. And typically when that happens, that supports a strengthening of the US dollar versus the euro.
And that is the global view of Roukaya Ibrahim from BCA Research. All right, that is the show for this Thursday. As I mentioned earlier, we are expecting the local market to begin lower. As you can see there, SPI futures off close to 0.5%. That's after some heavy selling we saw on global markets overnight in the view of certainly what's going on in the States there, what we've just been talking about with the services sector and concerns of reinflation perhaps. And also, of course, we're seeing that with the higher price of oil with US futures in the oil space now at $90 a barrel. That's also off the back of those extended supply cuts we've got from both Saudi Arabia and Russia. All right, stay with us. The Open is just around the corner.